One of the big themes that I've had over the last 6-7 months in the oil patch is low Canadian oil prices. It's in the news every day, like whether it's pipeline constraints for heavy oil in Canada or whether it's refinery constraints for the light oil in Canada. This is now front page news. Everybody's heard the numbers. We're losing $50 billion a year, $30 million a day because of our low oil prices. And isn't it a national travesty? And how come government, industry, and the public can't work together to get all these pipelines put together and start realizing a lot of profit potential? And so, and everyone, and the tone starts to get self-righteous, and geez, and sometimes it's deservedly so, because the Americans are very actively sabotaging all our efforts to get pipelines built. The Americans absolutely do not want a Northern Gateway pipeline. They want all the oil to themselves. In fact, just the other day, one of the analysts out of New York, Ed Moores from Citi, he said, oh yeah, there's going to be lots of Canadian oil going to Asia, lots of Canadian oil, don't worry about that. But it will be going through the Gulf Coast to get there, which I just thought, how embarrassing is that we cannot build a pipeline 1,000 miles long. Instead, we're going to build a pipeline 5,000 miles long, ship it to Louisiana, and then put it on a barge for 10,000 miles to get it to Asia. I just think that's a very sad comment on what kind of national interest our business and government leaders have been able to generate. So at the same time, it's like, okay, well, that's just reality. What are we going to do about that? So my job isn't to get all huffy and gnash my teeth and stomp my feet. My job is to make money. So it's like, okay, so if we've got low Canadian oil prices, that means somebody's making money off that. So let's find out who that is, and if you can't beat them, join them. So really the big setup here that I'm going to go through quite quickly here, both in Canada and the US, you're seeing a huge increase in production. In the US, it's light oil. In Canada, it's heavy oil. And it's absolutely overwhelming the entire North American refinery complex. So what we're seeing now is that's the number one reason that you're seeing all these low oil prices. And I'm going to go through that in a little bit of detail. But it's a very simple supply-demand. There's a lot of supply, and North American demand's fairly low. So you're seeing lower Canadian oil prices. And who's making the money here? It's the US refineries. They are absolute cash cows right now. In fact, they're literally by the month, they're getting more profitable as their crack spreads, it's called, goes higher and higher. So they're buying low-cost gas and selling high-cost gasoline. So here in Canada, you can see just what the heavy oil is looking like. They are doing such a good job, both in the SAGD and the mining, in getting oil out of the ground. They're reducing costs. You got to remember, these assets cost billions and sometimes tens of billions of dollars. So what we're seeing here with low oil prices right now isn't that big a concern, because they're looking 50 years out. And the reality is that we lose about 4 million barrels a day to natural declines around the world, and yet world demand is increasing by about 1 million barrels a day per year. So contrary to what anybody would tell you, the world still needs our Canadian oil, and we are responding. And in the States, of course, it's just been a stunning picture, an absolutely stunning picture, how in the last 5 years, the United States oil production peaked in 1970. It was on a straight line down right up until 4 years ago. And this is North Dakota, where the Bakken is. That is an absolutely stunning chart. It has increased production about 800,000 barrels a day each year for the last couple of years. In Texas, I took out that slide. In Texas, it's the exact same thing. I could have put down here Texas instead of North Dakota, and it is the exact same chart. It is just an unbelievable turnaround. 20% of all oil rigs in the world are now active in Texas. They've got 2 new shale plays, one in the west, one in the east, and it's just rocking. So what happens here's where you get to follow the money trail, you get to follow the oil trail. So all the oil comes down right now from Canada into the US through a couple different pipelines. But most of those avenues move towards Chicago. So where all of a sudden now you've got our oil going down through the pipelines towards Chicago before it kind of gets diverted down through to Cushing, Oklahoma, and into the Gulf Coast. But of course, that's where the Bakken is. That's where the big light oil deposit, the granddaddy of them all so far, is located. And with the fast rising production out of there, we're having to compete for pipeline space. So what's happening here is you've got 2 rivers of oil meeting in the upper Midwest and fighting for capacity. And basically, whoever's willing to take the lowest price wins. And that's why you're seeing the landlocked crude be much cheaper. So there's no pipelines going east-west in the United States. Like you've got small ones here and there, but there's no big national trunk lines like there is going north-south from up and down the Mississippi to the Gulf Coast Refinery Complex. So for refineries to get, on the East Coast or the West Coast to get this oil, it can only happen by rail, which is happening now in a big way, but it is a very recent phenomenon. There are no pipelines going east-west. So when I say you have to buy U.S. refineries, you have to buy a very certain set of refineries, and that are the ones that are inland, up and down the Mississippi. If you go buy a refinery stock that has all its assets on either the West Coast or the East Coast, those guys don't make any money because they don't have access to that cheap interior crude. They have to import all the expensive Brent crude, and so they don't make any money. And the guys in the interior, they're paying $20 to $30 a barrel less for their oil. So it's like any simple business. When you're paying less for your input costs, you're going to make a lot more money. And of course, here's the WTI Brent spread. Now this goes through to August 12th of August of 2012. I can tell you right now, it's about the same today. It's about $20, $22. And the big theory was last fall, okay, the Brent WTI spread, so the world price of Brent that's out there for the rest of the world, and the WTI price that's landlocked at Cushing, all these new pipelines are going to bring WTI up closer to Brent. But of course, what's happened is basically that hasn't happened. You've seen more refinery capacity come on, you've seen more pipeline capacity come on, and the spread is still the same because production is increasing so rapidly. So basically, Canadian, and here I'm going to make this the case where we need to be very careful here because I think light oil in North America is setting itself up for a potentially large drop later this year. And so what's happening right now is all our oil is hostage to the U.S. refinery complex. There's very little refinery capacity in Canada, and we don't have the pipelines yet to flow it out east. So, and there's been no new refineries in the U.S. since 1976. So basically, and most of those refineries have been switching to heavy oil because until the shale revolution 4 years ago, the quality of oil in the world was getting heavier and heavier every year. So that's what's given these refinery fits, because all of a sudden they've got this huge new source of supply of beautiful light sweet crude, but they don't have the capacity to process it. They've been switching from light to heavy for the last decade. They've lost over 500,000 barrels a day of light oil capacity moving to heavy. But all this is sadly not good news for us because we don't get to pay any less at the pump. All this cheap supply of oil, we're drowning in oil in North America, not just swimming, but drowning in it. And it's not going to make one iota difference at the pump. And the reason for that is exports. All our refined products that we make, the fuels like jet fuel, diesel fuel, home heating fuel, we export unbelievable amounts of that. So this is a chart showing, again, a few months old, but it's, again, even in 13, it's the same thing. We're exporting our gasoline, and the red bar is called distillates. Distillates are what they call the middle fuels, like home heating fuel, diesel fuel. Like, I grew up on a farm just outside of Toronto, and I can remember my dad saying, geez, because diesel was cheaper than gas for years. And then about 10 years ago, diesel got more expensive than gas. And of course, everyone just says, oh, those rotten oil companies, they're screwing us, blah, blah, blah. And I didn't know any better at the time, but as you get into the business, you realize, oh, most of the rest of the world actually operates on diesel, not gasoline. Here, we're mostly gasoline in North America with some diesel. The rest of the world is mostly diesel with some gasoline. So the demand out of the rest of the world has just picked up to the point where it's just more expensive. And so this has been the reason that we're not paying any less at the pump. We are now competing basically against all of Latin America, who's our big export market out of the Gulf Coast, for all our cheap energy. So we don't get any domestic break for that. So if we want the fuel at all, in fact, there was a very real concern last fall that if we had another cold winter, not like, you know, this winter's been a little bit warmer than normal, but last winter was way warmer than normal, sorry. And so if we would have had a fairly normal Canadian winter like we used to have 20 years ago, there was a very real concern out there that we would not have enough home heating fuel to heat all our homes here in North America. And of course, Mother Nature saved us. But the point is that all that exports is really why we're not getting any break at the pump. So these refineries, very simple business model, buy cheap WTI. All the products that they sell, these refined fuel products, they're sold on Brent prices. So they're making a $20 a barrel spread on all these products, and that's why they are cash cows right now, unbelievable cash cows. And so the street says, well, you know, that's not going to be the case for very long because we've got all these new pipelines coming in. But you can make this story very, very simple, and that is last year the U.S. increased, depending on who you want to believe, oil production anywhere between 800,000 to 1.3 million barrels a day. And there was no new refinery capacity. So that really, simple supply demand says you're going to have lower prices. The only other thing I would say here is that as we get going later this year, what I'm going to be watching for very carefully is we now only import probably less than 1 million barrels a day of light oil into the Gulf Coast. The U.S. imports about 6 to 7 million barrels a day, but it's mostly heavy. So all this light oil that we've been producing has been displacing foreign imports, mostly West African oil. So as soon as that last barrel of imported light oil has been displaced and it's only domestic production filling the Gulf Coast Refinery Complex, that's when we could see a pretty big drop in light oil prices in North America, because basically that has been the relief valve. All these imports that we're displacing have been the relief valve for all this surging light oil production. So basically when that's done, there's a good chance, I think, at that point in time when we could see a domestic light oil price not drop the same amount that heavy oil has done, because our constraints are different. It's not a pipeline issue, it's a refinery issue. So I think at that point in time, we need to be very careful about our investments in the producers to make sure that they're hedging as much as possible right now when the prices are absolutely fantastic. And, but that's what I think could be on the drawing board for later this year. I think for sure a $5 to $10 barrel drop in light oil prices, but depending on how it all shakes up. And the one thing I want to say too is that there are so many moving parts right now with pipelines, refineries, production, so many data points that I'm giving you a theory here that I think is probable, but nobody really knows. And you're going to read lots of stuff out there. There's a guy at the Bank of America, Francisco Balash, I think is his name. He's been on BNN a couple times, and he's calling for WTI because he's got the same idea I do. And he says, yeah, I mean, he thinks WTI is going to $50 later this year. I'd suggest that's a little harsh, but his idea is predicated on the same argument that I've just given you here, is that once light oil imports is done, we're going to see a very steep drop in light oil prices. And again, unfortunately, it's not going to mean anything for us at the pump.